Let me ask you something. When was the last time you actually felt confident about your financial future? Not just okay, not just getting by, but genuinely confident. If you're struggling to answer that, you are not alone. And honestly, that's exactly why we need to talk today. Because right now, in 2026, the rules of the game have completely changed, and the people who understand these changes are going to come out way ahead. The people who don't? Well, they're going to leave a shocking amount of money on the table without even realizing it. Here's what's wild. Most people have no idea that two massive pieces of legislation just rewrote the entire playbook for taxes and retirement in America. We're talking about changes so significant that financial advisors across the country are completely rebuilding their clients' strategies from scratch. And whether you're 25 years old, just starting your career, or you're already retired and collecting Social Security, these new rules are going to directly impact your wallet. So stick with me because by the end of this video, you're going to have a crystal clear action plan that you can actually use. Let's start with the backstory, because context here is everything. For years, there was this ticking time bomb in the tax code. Back in 2017, Congress passed a sweeping set of tax cuts. Big ones, the kind that put real money back in real people's pockets. Lower brackets, bigger standard deductions, better deals across the board. But here's the thing nobody really talked about at dinner tables. Those cuts were always designed to be temporary. They had an expiration date baked right into the law, and that expiration date was December 31st, 2025. If nothing changed, millions of Americans were going to wake up on January 1st, 2026, and quietly, automatically owe more in taxes without a single vote being cast. The 12% bracket would have jumped to 15%. The 22% bracket would have climbed to 25%. It was a slow-rolling financial avalanche headed straight for us. And then Congress actually did something. They passed two landmark pieces of legislation. The One Big Beautiful Bill Act, which went way beyond just stopping that tax cliff, and the Secure 2.0 Act, which was passed back in 2022, but deliberately saved its biggest and most complicated changes for right now. Put these two together, and what you have is an entirely new financial rulebook, a new normal. And understanding it could genuinely change your life. So, what does this new normal look like? Well, the core tax structure you've gotten used to is now permanent. Those 7 tax brackets are locked in. That generous standard deduction that makes filing so much simpler for millions of families, that's here to stay. The personal and dependent exemptions are still gone, yes, but the trade-off is something genuinely precious in the world of finance. Certainty. For the first time in years, you can make a 10-year financial plan without some expiration date lurking in the background, threatening to blow it all up. Now, a quick reality check here because I want to be honest with you. The word permanent in Washington is, let's be real, a flexible term. A future Congress can always change things. But today, right now, we have the most stable planning environment we've had in nearly a decade, and smart people are using that stability to their full advantage. Now, here's where it gets really exciting, especially if you or someone you love is over 65. The new law didn't just lock in old rules. It created something brand new, a dedicated, significant tax break built specifically for seniors. It grew out of a campaign promise to eliminate taxes on Social Security entirely. And while it doesn't go quite that far, what it does deliver is still extraordinary. It's called the Senior Bonus Deduction, and the number you need to tattoo on your brain is $6,000, not per household, per person. So if you're married and both of you qualify, you're looking at a potential $12,000 reduction in your taxable income. For most retirees, that is life-changing money. To qualify, you simply need to be 65 or older by December 31st of the tax year. But here's the catch you absolutely cannot ignore. This deduction is only available from the 2025 tax year through 2028. After that, it's gone unless Congress extends it. That gives you a short, powerful window to act. The deduction phases out based on your modified adjusted gross income, starting at $75,000 for single filers and $150,000 for married couples. But even if you're slightly over those thresholds, you might still qualify for a partial deduction. This is exactly why timing your IRA withdrawals and managing capital gains before year-end can literally put thousands of dollars back in your pocket. And there's more good news stacked on top of that. You can claim this deduction whether you itemize or take the standard deduction. And it layers directly on top of the extra standard deduction that seniors already receive. You get both. Two breaks running simultaneously, reducing your taxable income in ways that simply weren't possible before. Now, let's talk about retirement savings, because the contribution limits have taken a serious jump upward. The standard 401k contribution limit for 2026 is now $4,500 for anyone under 50, but it's the older workers who are really being handed a golden opportunity here. If you're 50 or older, you can add a catch-up contribution of $8,000, bringing your total potential savings to $32,500 in a single year. And there's a special super catch-up window for people aged 60 through 63 specifically. Their catch-up limit hits $11,250, which means they can potentially sock away $35,750 in a single year. That is a powerful, narrow window to seriously accelerate your retirement savings right when you need it most. IRA limits have climbed too, with the base contribution now at $7,500 and a higher catch-up bringing the total to $8,600 for those 50 and over. For higher earners, there's a major new rule you cannot be caught off guard by. It's called the mandatory Roth catch-up. If your wages in 2025 were over $150,000 and you're 50 or older, every dollar of your catch-up contribution must now go into a Roth account. No choice, no flexibility. The government wants the tax revenue now instead of later. More importantly, if your employer's plan doesn't even offer a Roth 401k option, you lose the ability to make catch-up contributions entirely. Check this immediately. Do not wait. And for families with significant wealth, there is genuinely wonderful news on the estate planning front. The federal estate tax exemption is now a permanent $15 million per person. For a married couple, that's $30 million combined. The old exemption was about to get slashed nearly in half, dropping down to around $7 million and sending wealthy families scrambling into rushed, complicated planning strategies. That cliff is gone. Families can now make calm, thoughtful, long-term decisions about their legacy without panic driving the process. So here's your action plan. If you're 65 or older, check your income right now and figure out if you can claim that new $6,000 deduction. For everyone saving for retirement, log into your accounts this week and seriously consider pushing your contributions to the new higher limits. If you're a high earner over 50, verify your 2025 income and confirm your plan has a Roth option before you make another contribution. And if your family has significant assets, call your financial advisor and get your estate plan updated immediately. The big theme here is permanence and opportunity. The scary tax cliff is behind us. The foundation is stable. But stability is only valuable if you actually build something on it. The window to optimize is open right now, and the smartest thing you can do is walk through it.